Nobody heard the alarm, because the empire was designed not to look like an empire. It was not a bank. It was not a famous hedge fund. It was a private family office, hidden behind swaps, prime brokers, and borrowed size, until one bad unwind made major Wall Street banks realize they had lent to the same unseen giant. This is Saul, and the Archegos collapse is terrifying because it did not begin with a public warning. There was no famous fund letter, no noisy investor presentation, no crowd at the gate. There was only a quiet man, a private vehicle, and a structure that allowed huge exposure to grow in the dark, while almost everyone believed someone else must have the full picture. At the center was Bill Huang, a former fund manager who rebuilt himself through Archegos. Officially, it was a family office, managing private money, not outside capital. That distinction mattered. It gave the operation a different shadow, less scrutiny, less public reporting. Few outsiders saw the beast, but Archegos was not small, in effect. Through total return swaps, it could gain vast exposure to stocks without showing up like a normal shareholder. A swap is a quiet instrument. The bank sits between the stock and the client. Gains flow one way, losses flow the other. On the surface, it can look clean, technical, contained. That is how opacity becomes power. Archegos built huge positions in a few media and tech stocks. The positions were not merely large, they were large at several banks at once. Each bank could see its own relationship. Each bank could see its own risk. But no single bank clearly saw the whole creature. That was the fatal asymmetry. When markets are calm, hidden leverage looks like sophistication. It looks efficient. It looks like a private client using clever instruments. The danger is that every bank thinks it is holding one piece of a manageable puzzle. Then the puzzle moves, and suddenly each piece belongs to the same trap. For a while the machine worked. Stocks rose, exposure grew. The banks earned fees. Archegos gained size. Everyone had reasons not to interrupt the flow. This is how dangerous structures survive. They do not need mass corruption. They only need everyone to be paid to stay comfortable. The psychology was elegant and primitive at the same time. A successful client gets treated differently. A client who trades large, pays well, and appears controlled becomes valuable. The banks do not just see risk, they see relationship. They see future fees. They see the fear that a competitor might take the business if they ask too many hard questions. That fear is not written in the contract, but it sits in the room. Then came the crack. Some of the stocks tied to Archegos began falling, including Viacom CBS after pressure around a share offering and weakening market appetite. In a normal portfolio, losses hurt. In a leveraged structure, losses become a countdown. Margin calls arrive. Collateral must be posted. If it is not, banks begin to protect themselves. This is where silence turns into panic. The banks suddenly face the same ugly discovery. They were not just dealing with their own exposure. They were standing in a circle with other banks holding similar exposure, and the first ones to sell would likely survive with smaller wounds. The last ones out could be left holding the damage. The polite world of prime brokerage became a dark alley with one exit. A meeting was held between banks as they tried to coordinate the unwind. That sounds calm. It was not calm. In finance, coordination in panic is unstable because every participant is quietly calculating betrayal. If everyone waits, maybe losses are contained. If one bank sells first, it can save itself. If you wait while your rival sells, you become the sacrifice. Goldman Sachs and Morgan Stanley moved quickly with large block trades. Others were slower. The speed difference mattered. In a collapse like this, minutes and decisions become weapons. A stock sale is no longer just a sale. It becomes a signal. The market sees supply, prices fall. The remaining exposure becomes more poisonous. Nomura and Credit Suisse were among the institutions hit hard. Credit Suisse, already under pressure from other failures, suffered a brutal loss. What had looked like a private client problem became a public humiliation. A family office had forced global banks to show how little they really understood about the risk inside their client ties. This is the part that makes Archegos different from the old image of crash. There was no mob of investors shouting in the streets, no ordinary bank run, no dramatic trading pit. The violence happened through calls, risk systems, private messages, block trades, and quiet screens. Modern collapse often looks like silence from the outside. Inside, it is a knife fight. No bell rang, no crowd saw it, no one ran in the street. The pain moved by call, by chat, by price, by fear. That is why it felt so cold. It was not chaos with a face. It was risk with no face at all. And no one in the room felt safe for long. The real question is why the banks allowed it. The answer is not simply stupidity. It is appetite. A private client with huge flow can addict a bank. Fees create warmth. Past success creates trust. Warnings compete with revenue. Risk managers may see danger, but traders see business. Executives see status. And when a client is important enough, the ugly question becomes expensive to ask. How much of this position exists elsewhere? That was the question that mattered, not just what do we know, but what is hidden because another bank is paid not to show it. Swaps created a kind of mirrored room. Each bank saw its own reflection and mistook it for the whole space. Archegos stood in the middle, multiplied through relationships. Clustered risk looked diversified because it was split across banks. But from the market's point of view, it was still one giant pressure point. That is the brutal logic of hidden leverage. It does not disappear because it is distributed. It only becomes harder to locate before it detonates. Bill Hwang became a symbol of something deeply uncomfortable. He was not running a public fund at the time. Archegos was private, quiet, almost invisible. But invisibility can feed ego in a different way. Public fame demands performance. Private leverage allows a man to build scale before the crowd sees the stage. And once the positions grow large enough, the market becomes part of the prison. You cannot exit quietly if your own size moves the price. You cannot reduce risk without revealing risk. You cannot ask for help without alerting the people whose fear makes it worse. That is when leverage stops feeling like power and starts behaving like captivity. The Archegos collapse exposed a mental failure across the system. Banks wanted the income. The client wanted the size. Risk models used yesterday's calm to explain tomorrow's danger. Everyone behaved as if Polish reduced the animal nature of markets. It did not. It merely gave the animal a darker room to hide in. When the unwind came, the language stayed technical, margin, swaps, exposure, prime brokerage, block trades. But beneath those words was something older. Rivalry, fear, reputation. The terror of being last, the scramble to escape before the other powerful men in the room did the same. Hidden leverage always feels safe until the crowd discovers it all at once. This is opacity, ego, and cluster risk dressed as sophistication. Archegos did not need to be famous to become dangerous. It only needed enough borrowed size, enough willing banks, and enough darkness in the mirrors. The final shape is chilling, because no single part looked insane by itself. a family office, a swap, a bank relationship, a rising stock, a margin call, a block trade. Each piece had a clean explanation. Together, they formed a machine that could not survive exposure to light. That is what modern finance often looks like now. Not a vault full of gold, not a loud exchange floor, but invisible claims layered through private contracts, trust, and assumptions that remain safe until someone runs for the exit. Thanks for watching. If this gave you a sharper view of wealth, power, and survival, like the video and subscribe for more from the Aurelius Method. I am Saul, and I will see you in the next video. Tell me in the comments, what is more dangerous in finance? The risk everyone can see, or the leverage hidden behind respectability?